Hey everyone, welcome back to Yuri's Box. In this video, I'm going to talk about the S&P 500. Are we pricing in a recession? If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. So I've read a few headlines, come across X, how this move that we've had in the last few weeks is because of recessionary fears, because of we are starting to price in a potential slowdown and things along that line. And I've listened to many people. I've read many takes on X and on YouTube, and I find myself agreeing with people that I don't think we are really pricing in a recession. Okay, and I'll try and keep this video short. So if you've seen my previous videos, really, you know where I stand. My expectations coming into the year are that optimism on growth is misplaced, just like pessimism on inflation is misplaced. I think the two should be flipped. Leaving aside all of the Trump policies that we've had ever since he got in office, you could already see that in things like the quits rate. Okay, well before Trump got into office, you saw the quits rate at cycle lows. You can use this as a barometer, and I bring this up very often in my videos that the quits rate is a barometer of people's actions. It's a survey of people's actions. People are telling you via the quits rate that they don't see the excesses of a few years ago. Okay, they're acting in a defensive manner, and that is again a barometer of where the economy is. We're no longer in a state of abundance, and so we are more likely to be in a state of a slowdown. Now, that doesn't mean the thing is falling off a cliff. It just means things slowing down. Okay, so that was already in motion well before Trump got into office. You can also see that with the hirings, well below the cycle highs. You can also see that with continuing claims. Okay, it's getting harder for people to find a job in the event they lose a job, their job. Okay, but then Trump gets in, and there are a series of policies, mainly tariff saber rattling, which puts uncertainty into the system, because you have tariffs one day, tariffs off the next day, which is in turn worse than having just tariffs, because you, as a business, you can't really plan ahead because you don't know what framework you're dealing with. Okay, so you have that as well. I mean, if tariffs get put into place, that is a headwind to growth. As I've explained in my previous videos as well, just by looking at quits rate, hires, any bout in inflation from here on out is likely to be an extra drag on growth, because if people don't have that extra income, it's just going to eat into their disposable income, and people are more likely to quit spending. Okay, say I'm going to spend less overall, and so again, any bout in inflation is, at least as far as I'm concerned, is to be regarded as a further drag on growth. So you have tariffs being put into place, you have layoffs being put into place at the government level, at the federal level, as well as fiscal tightening with grants, contracts getting cancelled that were previously in place and that were providing stimulus to the economy. You have these factors that, as long as they continue to manifest, they lay out a scenario in which the slowdown continues. And the way the slowdown stops, as I've argued in previous videos, is with an external positive shock, quote unquote. Okay, and what would that shock be? Well, for example, take the Federal Reserve announcing a emergency huge rate cuts, or Trump announcing basically Trump talking back all the tariff policies. So you get tariffs pushed aside, and you potentially start talking about tax cuts. That would eliminate all of the uncertainty. Okay, and you would no longer be in the environment I described before. As long as you have the tariffs, the layoffs, and contributing to the slowdown that was previously in place, what's more likely to happen is risk assets taking a beating. And that leads me to answer the question, are we pricing in a recession with this latest move? And the answer is no. I agree with people that disagree with the premise. And there are a few ways you can see that. One way is credit spreads, which, pardon me, although have broken out of this, trend line, it's still not dramatic, and you still have to see if this plays out. Although this would be one of the places you would see, growth scares, manifest. Okay, keep an eye on credit spreads. But again, it's still nothing too dramatic, although we're still moving up. Nothing too dramatic. Where you really see that recession is really not being priced in is the bond market. Now, it is true that things like the 2-year have still more or less in the range where they were last summer. Things like the 10-year are still at fairly elevated levels. We are at 430, which is where we were at the end of 2022, which is where we were smack in the middle of 2023, at the end of 2023. Again, we're at levels in the bond market not seen since 2023, without the growth seen in 2023. And to drive the point home, we are still far away. We are about 80 basis points above where we were in last summer, where we were indeed considering the fact that we might be heading into a recession. Okay. I think the best way to see whether or not what is it we're pricing in precisely. I think the bond market is telling you we're not pricing in a recession. I think the move that we see right now in the S&P 500 is due to the fact that up until now, the stock market has priced in all the good stuff, the best of everything. And tariffs and fiscal tightening have kind of thrown a wrench into that. If you come into the year expecting the best, and you have something minor, even something minor. Now, I'm not saying that tariffs and layoffs are something minor. Don't get me wrong. I'm just saying, imagine if you had something. I mean, again, if you have something come to call into question perfection, so having to go from perfect to maybe good, that is a cause for reconsideration. And I think this is what is more likely to be the culprit. Okay, it's not so much that we're pricing in a recession; it's that we're reconsidering the baseline that we had coming into 2025. Okay, coming into 2025, what do we have? We had optimism on growth, which again was probably misplaced in my opinion, but regardless, that's what we had. So optimism on growth. and somewhat more pessimism on inflation. Tariffs and fiscal tightening are calling into question that baseline. And I think that is what is being reflected in the stock market. So it's not so much a pricing in of a recession, it's just making the waters less clear, okay? Um, it's not a recession. Again, it's probably considering the fact that, again, it's not perfect anymore. So as I said in my previous videos, you have starting to consider going from better, perfect to good. So potentially slower growth, but not a recession. So slower growth, but not a recession. And the uncertainty. I think that is what's being considered at the moment by things like the S&P 500. In my opinion, if we were to see recession get priced in on top of this, that is an entirely other move. I've also made the case for a rally, at the very least a relief rally, but I've also said that I wouldn't get married to it in the case we were to have a relief rally, for the simple reason that as long as we operate in an environment where you have tariffs creating uncertainty, you have fiscal tightening, dimming the outlook on growth, everything has been laid out before us. It's more of the same, more of what we continue to see. More uncertainty, risk. It's basically risk off. Okay. So are we pricing in a recession? No. I think it's a combination of a dimmer outlook on growth, but not a recession, and the uncertainty tied to tariffs. Okay. If we were to price in a recession, that would be a totally different move. Okay. Even worse than this. I don't think that's what we're pricing in. That doesn't mean that we'll necessarily end up in that place. But as I've been arguing in this video and in my previous videos, if things continue to play out in this way, well, then the chances just become higher, and then eventually, potentially in the summer, that's one time frame I've highlighted in my previous videos. Then eventually you might have to consider it, but that's still far away as far as I'm concerned, for what I as far as my opinion is concerned. Okay, so to keep things short, no, recession isn't being priced in. And you can say that by looking at things like the 10-year, it is still fairly elevated compared to where it was in the summer. I think it is a combination of a dimmer outlook on growth, but not a recession, as well, combined with tariffs and tariff uncertainty. Okay, so again, as I try to point out in my videos, we are in a situation where what you have to look at really is the economic data, specifically PMIs, specifically initial claims, and see how the economy is holding up. Okay, we are at the mercy of economic data. That is where I think we are, and I think it is too early to say whether we're on a bear market or a correction. That is something that only economic data can settle, in my opinion. Okay, so I'll leave it at that. It's a shorter video than usual, but it is what it is. I'll again, if you like this kind of content, consider leaving a like, and I'll see you next time. Bye.